Deciphering debt, when bad debt becomes a strategic financial tool. We've all grown up hearing one absolute rule about money: debt is bad. It's drilled into us through cautionary tales of credit cards, payday loans, and financial stress. But here's the uncomfortable truth that advice is only half complete. Debt itself isn't the villain. Misused debt is. And when deployed with intention, structure, and discipline, even so-called bad debt can become a catalyst for financial acceleration. The bad debt illusion. Not all debt operates on the same playing field. High-interest consumer debt used to fund short-lived consumption is financially corrosive. It extracts future income without creating future value. That's the debt most people rightly fear. But lumping all debt into this category blinds us to a powerful reality. Debt is leverage, and leverage, when controlled, can compress time and amplify opportunity. The real question isn't, is debt bad? It's, what is this debt doing for me? The strategic borrowing playbook. Strategic debt is borrowed capital deployed toward outcomes that outperform its cost. Think low-interest student loans that unlock high-earning careers, or mortgages that allow access to appreciating real estate while inflation quietly erodes the real cost of repayment. In these cases, debt isn't a shackle, it's a lever. The principle is simple but non-negotiable. If the return generated by the borrowed capital exceeds the cost of that capital, debt becomes a growth mechanism rather than a liability. Used correctly, debt accelerates access to education, assets, networks, and opportunities that would otherwise take decades to self-fund. Conditions for transformation. Debt only becomes strategic under specific conditions. Interest rates must be favorable. Repayment terms must preserve cash flow. Most importantly, the purpose of the debt must be intentional and measurable. Borrowing without a plan is speculation. Borrowing with a framework is strategy. Equally critical is personal stability. Strategic debt rests on a foundation of predictable income, an emergency buffer, and emotional discipline. Without these, leverage magnifies risk instead of reward. Navigating the fine line. This is where many fail. Over-leverage, lifestyle inflation, and blind optimism turn strategic intent into financial fragility. Markets shift, returns disappoint, life intervenes. Debt requires monitoring, reassessment, and humility. It is never passive. The smartest borrowers continuously audit their leverage, stress test assumptions, and remain willing to unwind positions when the math no longer works. Your debt-deciphered action plan. Start by auditing your existing debt. Separate what consumes from what compounds. Evaluate interest rates, opportunity costs, and upside potential. Then, and only then, explore strategic opportunities aligned with long-term goals, ideally with professional guidance. The final takeaway is this: debt is neither good nor bad. It is a financial instrument. In untrained hands, it destroys. In disciplined hands, it accelerates. Used wisely, debt doesn't delay freedom, it can shorten the path to it.